So welcome to your video on closing entries, and I'm going to start by visiting a page from your book. I'm not exactly sure what page it is, but it is in chapter 3, probably around page 122 maybe. It depends on what edition we're working on currently. Sometimes the page number changes by a number or two. Anyway, what you see here, this list represents the accounting cycle, where we start and where we end. So just to kind of refresh for you that you already know most of this and have done most of this in your comprehensive problem, the first step is to analyze transactions. So this is where you take a look at a transaction, figured out what happened, and determine what you need to do with it so that you can journalize them. So this is, for example, when we said owner invested cash of $20,000 in the business in exchange for common stock. That is a transaction. You analyze it, and from there, then you prepare a journal entry. That's called journalizing. So that's where in your general journal, as you did in Part A, you recorded each one of the transactions with the appropriate debits and credits in a general journal. And then also in Part A, you then posted from your general journal into the general ledger accounts. That's where you transferred each debit and credit in your journal to the appropriate general ledger account. And then you figured out what your ending balance was in the account. And the ending balances then were brought forward in, in Part A to your unadjusted trial balance. That was the ending part of Part A. And then Part B picked up on step number 5, which is where you adjusted the accounts. You analyzed them to bring them up to date. You journalized the adjustments. And then in Part B, we introduced that worksheet. So you got to post in the worksheet rather than to post in the general ledger. So you got to post in the worksheet. And the first column was your unadjusted trial balance. The middle columns were your adjustments, debit and credit. And then the final columns contained your adjusted trial balance. So that's where Part B left off, number 6. So in Part C, we're going to do 7, 8, and 9. So number 7 is to prepare your financial statements. So after your trial balances reflect the proper balances, you've made all your adjustments. So now we prepare our financial statements. We're going to prepare an income statement, a statement of retained earnings, and a balance sheet in that order. And as you'll recall from the administrative video, you need to prepare a classified balance sheet for this part of the assignment. If you're not quite sure what that is, please go back and review that first video where I refer you to the proper pages in your book. And then we're going to close the accounts. We're going to talk about this in just a moment. What does that mean to close the accounts? And then we're going to prepare a post-closing trial balance. These two parts are really, really simple, so you'll be happy about that. And preparing the financial statements, you've already done that. You've done it in the respective chapters. You've done it at least twice. And I know we did it in chapter 1 or 2, and then I think we did it again in chapter 4, and you did it on the first test, and you did it in Part A, and now you're going to do it for the final time in Part C. So you've done it a lot. That shouldn't be too much trouble for you to be able to do that now, having done it so many times. Like I said, the closing and the post-closing trial balance steps, those are really easy, and those are the subject of this video. So we're going to go ahead and get started on that. I do want to tell you that step 10, reverse and post, is an optional step. We did not cover that in this course. If you go on to study at higher levels of accounting, particularly Accounting 3, I think we cover that. and it was in the appendix in chapter 3, and of course we did not cover anything in the appendix. So let me go ahead and close this, and I'm going to refer you into your textbook here. And this is, looks like page 118 in your textbook. Again, if it's a different edition, your page number may be off just a little bit. But what we're going to do is we separate our accounts into temporary accounts, as you see here, and permanent accounts. So our temporary accounts are closed at the end of the period. That period could be a month, it could be a quarter, it could be a year. However, your entity reports, your business reports. So we're going to close the accounts. I think probably we're going to be closing, just the month of May. So we're going to close our temporary accounts out at the month of May, which means that we're going to close them out so that they end up with a zero balance to start the next period. So if you notice, those accounts are revenues, expenses, dividends, and our income summary. We'll talk about income summary in a few minutes. But we already know what revenues are, so we accumulate, our professional fees earned all month long, and then we're going to have to close it out to zero so that for the next month, in June, then we'll have the revenues just for the month of June in there. So we're going to close them out to zero. And in reality, we probably do this only once a year, where we close out our, well, I guess I should say for a small entity. For a large entity, you actually will probably be closing monthly. And so we're going to close the revenues and the expenses to zero. We're going to close the dividends to zero. I'll show you how to do that. And then we're going to close income summary to zero. So all of these get closed at the end of the period so that they may start the new period at zero and start accumulating again. These accounts over here, which appear on our balance sheet, if you notice, revenues and expenses are on our income statement, and we have dividends on our statement of retained earnings. Everything here is on our balance sheet. So these are not closed at the end of the period, which means they describe it down here. They say retained earnings must reflect the prior period revenue, expenses, and dividends. Actually, what was I looking for? Something, maybe it's up here. Oh, this is what I was looking for. No, I don't see where it is, but just suffice it to say that the permanent accounts, their balances carry forward, their ending balances carry forward and become the beginning balances of the next year. So again, if it makes logical sense, if we're talking about assets, if we were talking about the cash asset, if cash ends at $100,000 at the end of May, well then our beginning balance on June 1st is $100,000. If our revenues are $125,000 at the end of the period, we're going to close them to zero so that our beginning balance at the beginning of the next period is zero, and we start accumulating again. So let's show you what that looks like. I think it'll be clearer when we actually do the entries. So we are only going to close our temporary accounts, and please remember that you should have already done your income statement, statement of retained earnings, and balance sheet. And now we're going to close our temporary accounts to zero so that we can be ready for June 1st. Okay. So this is a solution from a prior semester. It is not your solution, and I even made it a whole lot shorter. I took out a lot of revenue and expense items here out so that it wouldn't be a long demonstration here. We're just going to keep it short. So that your starting place for part C is going to be the adjusted trial balance. And these two columns will be effectively, this is the finishing part of part B that you did. You're going to work with my solution. This is where, I wonder if it shows there. Let's see here. Hang on, I'm going to pause just a sec. Okay, so this is the worksheet that, or it looks very much like the worksheet you would have completed for Comprehensive Problem Part B. And that's where you started with your unadjusted trial balance. This came from all of your transactions that you had journalized in Part A. And then in Part B, we were calculating and making adjusting journal entries. And so we posted them in this column. We didn't have to post them in the general ledger anymore. We were able to do it on the worksheet. And then we, took our beginning balances and incorporated in our adjusting entries in order to figure out what our ending adjusted trial balance was. This is the starting point for Part C. So let's get back to it. So here we go. So the adjusted trial balance is the starting point. All of these accounts here that go on the balance sheet are not going to be closed. Okay, their balances are going to carry forward into June. So the beginning balance of cash as of the end of June will be the same as it was at the end of May. However, when we come down here to these accounts, all of these accounts are temporary accounts that we just discussed, and they are going to be closed to zero. All right. So what does that mean? Well, if you take a look over here on this side of your screen, what I've done is I prepared T accounts. I went ahead and did it for you. The T accounts are not required. I'm just using them for demonstration purposes. I don't think that you will need them when you're doing your actual problem, but it is nice and easy for me to show you what we're doing if I'm using T accounts. So I also went and put the balances in the T accounts from our trial balance. So for example, dividends over here. Our dividends account has a balance, a debit balance of $550. Here's my T account for dividends. I put the debit balance of $550 in the T account. If you take a look over here at professional service fees earned, has a credit balance of $10,450.05. So again, I come over here to professional service fees. I already put the amount on the credit side of that T account. Now keep in mind, this is not your comprehensive Part C. This is one that I've done in a prior semester, and I shortened it. So your numbers are going to be different, and you will have more, possibly more revenue accounts and definitely more expense accounts. So I just wanted to keep it short for this video, as short as possible. So what we're going to do is we're going to first close out all of our revenue accounts. So we have two revenue accounts here with balances in them. Do we see that? We have professional service fees earned, has a credit balance of $10,450.05, and our interest income has a balance in it of a credit balance of $36.16. Of course, their credit balances, their revenues. The normal balance of a revenue is a credit. So I come over here to my T accounts. And in my T accounts, I have a T account for professional service fees earned, and it has a credit balance of the amount from our trial balance, and interest income has a credit balance of $36.16. Well, if I want these balances to be zero, that's what I'm trying to do. The first thing I'm going to do is close out my balances to zero. I want this to be a zero. In order for that to be a zero, I need to debit the account here. Sorry about that. I need to debit the account, $10,450.05. Agreed? If it has a credit balance of $10,450 and I debit it $10,450, I will be left with a zero balance. I'm going to do the same thing over here with my interest income. It has a credit balance of $36.16. I want to debit it $36.16 so that I will end up with a zero balance over here as well. Okay. If that's the case, then I've debited professional fees earned, and I've debited interest income. I'm going to come over here to my journal entry, and my date is going to be 5/31, the last day of May that I'm closing, and I am going to debit professional service fees earned, and my amount of that debit was $10,450.50. I'm sorry, yeah, 05. Okay. And I'm also going to be debiting my interest income. So again, what you're going to do is all of your revenue accounts. If you have 100 revenue accounts, then you're going to have 100 different accounts that you're going to debit. We only had 2 revenue accounts. They had credit balances in them, so we are debiting them to make them 0. Our offsetting entry, obviously, we need an entry that totals these two. The total is $10,486.21. And the account that we are going to close it to, we're going to credit an account called Income Summary. Here's our Income Summary account, and we credited it $10,486.21. Okay, so it now has a balance of $10,486.21. These two accounts are now zeroed and ready for the next year. Our journal entry is going to say to close revenue accounts to Income Summary. Okay, so our first closing journal entry is done. If we wanted to, we could now come over here into our worksheet and put the entries in here. We are debiting professional service fees earned. We are debiting interest income, and we are crediting an account here. Here it is, Income Summary. We are it has a 0 balance when it starts the period, and we are crediting it for both of these amounts, right? We said $10,486.21. All right, so we balance. Here's our journal entry. It balanced. We put it in our worksheet. Our worksheet balances, and we can then move on to our expenses. So what we know about our expenses is they have a balance over here in the debit column, right? They're in the debits side. All right. So we have depreciation expense, we have salaries expense, advertising expense, insurance expense, and, well, that's our income summary. That's not an expense. So we have 4 expenses that we need to close. We need to close them to 0. So let's come back over here to our T accounts. Here they are. I put the balances in there. Depreciation expense, salaries expense, advertising expense, and insurance expense, all on the debit side. I want them, when we are done, to be 0. I would like to have a 0 here to start the new year or the new month at 0. And so in order for that to happen, I have to credit depreciation expense in order to have the balance in that account become 0. Agreed? Okay, so our date here on our journal entry, let me just freeze those columns. Okay, so in our journal entry here, we're also going to date this 5/31. We're going to close them out at the end of May. The first one we're going to close is depreciation expense, except we are crediting depreciation expense, right? In order to make it 0. It has a debit balance, so we need to credit it by $770.83. Our salaries expense over here has a debit balance in it of $46.20. In order to make that become 0, You guessed it, we have to credit it, $46.20. And now the balance of that account at the end of May is 0. Okay, so that now also has a balance of 0. Okay, so we'll come over here to our journal entries, and we were crediting salaries expense. Why am I starting them over on the right? Because we have to indent our credits always, and that was for $46.20. I'm going to do the same thing here for our advertising expense and credit it for $790. Where did I get that? From right here. And the balance here is now 0. And we have the same thing over here. Sorry, I should have formatted them before starting this problem. So our insurance expense over here has a debit balance, so we need to also credit that and make it 0. So now debit balance, we credit it, it ends up as 0. So let's put our insurance expense up here and credit it for $300. Okay, but we don't balance. So what we're going to do is the same thing we did with income up here. When we debited our revenue accounts, we credited income summary for the total. We're going to do the same thing, but this time we credited all of our expenses. So we're going to add them all up, and that comes out to $6,480.83. And we are going to close that to income summary. Our description is going to say, I'm just going to copy it down, and then I'm just going to change. We're not closing the revenue accounts, we're actually closing our expense accounts, yes? So we're closing our expense accounts to income summary. And so we debited income summary, the amount of $6480.83. Okay. I'm just going to come down here and I'm going to put a sum. I just want to make sure my debits and credits equal always, right? And so if I check it along the way, and we can see that they do, I'll just do a little math here to make sure. Should be 0. Okay, it is. So they agree. That will just save me in case I make a mistake along the way. I'll find it and I won't get too far along and make that mistake. So, so I'm going to take our closing entry here, and I'm going to post it over here in my trial balance. So we debited income summary for $6480.83, and we were crediting our expenses here. So we credited, notice I'm in the credit column up here, see? So we're going to credit our depreciation expense. Whoops. Whoops. You know what I'm going to do? Instead of typing in, I'm just going to go grab it. And, not sure if you guys know anything about Excel. Whoops, that's not what we wanted to do. We wanted the formula. Let's see if it'll do it if I paste the formula. No? No? Okay, so I'm just going to go grab each one of these. I'm not sure why it's not behaving. It's okay. But rather than type them in and have a chance that I get them wrong, I'm just going to go grab them from where I did my entry. Okay, so here I do have my debits and credits totaling. I'm still in balance, so that's good. I've posted both my my closing entry for my revenue and my closing entry for my expense. Okay? And now all of my revenue accounts and all of my expense accounts have a zero balance, ready to start recording our first revenue and expenses of June. Okay, so we still have this income summary account over here. What's very interesting is, if you notice, your income summary account has a credit and a debit in it. And if we do the math on that, let's figure out what the balance is. Our balance, our credits are higher than our debits, so we're going to subtract the two, and it's a credit balance of $4,005.38. What's really interesting is this account right here summarizes our income statement. So when you're done, if you had net income, if you prepared your income statement, your ending balance here in income summary better equal your net income. If you have a debit balance, if your debit side was higher than your credit side, you would have a debit balance, and that would mean you had a net loss. But for this company, their revenue was greater than their expenses, so they had net income. And so the balance of the income summary is right now $4,005.38. But guess what? We don't leave that balance in there either. It's also a temporary account. Means it's just going to hold our closing entries, and then we're going to close it. This represents our net income, and we're going to close it to retained earnings. Do I have a retained? Oh, there's my retained earnings account. It has a zero beginning balance, so we're going to close this to retained earnings, which means this account now, I'll put it down here, this account also needs to end up at zero. And so if it needs to end up at zero, what does it need? It needs, if it has a credit balance, and we want it to be zero, we're going to have to debit the account in order to end up with a zero balance. Now, income summary has a zero balance. We debited it. So what are we going to credit? Well, I'm going to come over here and put my debit in first. Oops, I guess I just was using 531. I don't want that to reformat. Okay, so we were debiting income summary. Whoops, that's not my debit column. Here's my debit column. So we're going to debit income summary, and we debited it for $4,005.38. And our credit is going to be to retained earnings. So we're going to credit retained earnings, 4,005.38. And the description here is going to be to close income summary to retained earnings. So now we have closed income summary to retained earnings, and income summary now also has a zero balance. Our retained earnings, however, is a permanent account, so its balance is going to carry forward. We're not quite done with our closing yet, because dividends is also a temporary account. It has a balance in it of $550 from over here in our trial balance. Oh, what we should probably do is go ahead and post our amounts to our income summary. So our income summary has, what we did to it here was we, I think I'll show it this way. I'll show it the way you can do it. I'll let you do it this way. So our income summary, we debited 4,005.38, and we credited retained earnings. So let's come up here to our retained earnings account, which is up here in our equity section. Do we have it? Yeah, there it is. Okay, and we credited it for 4,005.38, And so we are going to debit our income summary. Income summary, we've already debited 6480.83. So we're going to debit it. We have the 6480.83, and then we are debiting it for another 4005.38. Okay, those numbers simply came from our journal, our general journal. So, so we are going to debit it. It ends up being a total the same as the credits because that makes sense. It's supposed to end up at 0. It has the same amount of debits as credits, so it ends up at 0. Where did those two numbers come from that I added? They're up here. See them? I added those two numbers. Well, they were in my general journal. One was right here when I closed my expenses, and the other one was right here when I closed my income summary to retained earnings. So now we also have to close dividends. So dividends has a debit balance in it. Its normal balance is a debit. And we also want it to be 0. So if we want it to be 0, just wanted to see if I was hoping my underline would copy. It didn't. So we also want it to be 0. In order for it to be 0, if it has a debit balance, we need to credit it to make it 0. So let's credit dividends. Notice I started it in the credit column, and that's for 531. And I'm going to close it to retained earnings. So I'm going to debit retained earnings 550. I'm going to put an underline there. I'm going to come over here and put that entry in my journal, my general journal. So we debited retained earnings for 550, and we credited dividends for 550, making it 0. And this says to close dividends to retained earnings. We're done with that, and that is the end of our closing entries. So all of our closing entries are done. Let's just make sure we balance down here. Looks like we do, so that's good. We have not posted this entry yet on our trial balance, so let's do that. We were debiting retained earnings, so here's retained earnings, and here's my close. See, this says closing entries here. These columns are simply for my closing entries. Notice there's nothing up here in our permanent accounts because we don't close them. So there are no entries that go up there. Our entries are all down from retained earnings down through all of our expenses. So we debited retained earnings for 550, and we credited our dividends account by 550, and we check to make sure we're still in balance down here. We are. It's one way that you make sure you're in balance at the end. So now we are, we're done with our closing entries completely. So the only thing I want to point out to you is this. Remember, when we do our statement of retained earnings, it looks something like this. I'm going to abbreviate. You are not permitted to abbreviate when you do yours. So you would have just done yours. So you would have had your retained earnings as of whatever date, May 1st, right? And that balance was 0. Of course, yours would be in good form, so it would have a title. Everything there would be no abbreviations, and you'd have dollar signs. I'm not putting any of that in there, but I'm just showing you that you start with your beginning balance of retained earnings, you add net income, right? And you deduct, well, you do make a subtotal first, and then you deduct dividends in order to come to your retained earnings as of May first. So this is what your statement of retained earnings looks like, except that, of course, yours is going to look a little nicer. We'll have a beginning balance of 0. We will have I guess I didn't really want to use that. Okay. All right. Okay. I like that to show 0, not a dash, but that's okay. We're going to add our net income. Net income is revenue less expenses. That should have been, when you do your income statement, 4,005. And then we deduct, well, we add these two together. It's the only number that we are not required to have a label on. And we deduct our dividends, which were 550. And we come up to our ending balance of retained earnings. And guess what? Here it is represented in our T account. We have 0. We credit it, making retained earnings go up by $4,005.38. Our closing entry, we made it go down by $4,005 by debiting it, $550. And so if I were going to do the math on this T account, I would take my beginning credit, I would add my additional credit, and I would subtract my debit balance, and boom, there it is. So closing this account, if you look in this account, it really should look in a T account just like what your statement of retained earnings looks like, except of course yours is going to have proper dollar signs, underlines, and headings. Okay, so we are done with our closing entries. That's what I'm asking you to do. And then let's just finish out by taking a look at what we're going to do in our post-closing trial balance. Oh, sugar. I didn't put any balances in there. Oh, what happened to them? Oh, I know why. Here they are. So I just couldn't see them. So here is our adjusted trial balance from the end of Part B. Again, this is not yours, but this is the same concept. Obviously, our assets have a normal balance of a debit. Our accumulated depreciation accounts have a normal balance of a credit. Our liabilities all have credit balances. Our common stock has a credit balance. Our dividends has a normal balance of a debit, and so forth. Revenues are credits, and expenses are debits. So we're just going to do the math here. Our cash, there were no entries over here, but if there were, I would certainly take my debit balance and I would add that debit and I would subtract my credits, and that would be my ending balance. So I'm going to copy that down. There weren't any entries here for these debits. And that's also the same thing, that debit. And my accumulated depreciation, we have a credit balance, so we're going to take that credit balance. A debit would make it go down, so I'm going to subtract any debits. A credit would make it go up, so I'm going to subtract that. And there's my ending balance. Did I have to do that? No, because there weren't any entries in here, but I'm just simply showing you, again, what you should have been doing in Part B when using the spreadsheet. Okay. Again, you can do that math. You don't have to use Excel. You can do it on your calculator. Okay, so all of our liability accounts, those balances all carry forward. And if we did our closing correctly, then our everything from dividends on down to our expenses should all have a zero balance. So let's take a look. Oh, well, first let's figure out the balance of our retained earnings. So our retained earnings had a zero balance to begin with, and then we debited that account. Debiting retained earnings makes it go down. So let's subtract the 550. Crediting retained earnings makes it go up. So let's add our credits, and our ending balance is 3455.38. We already knew that that's what it should be from our other spreadsheet, our closing spreadsheet. So let's take a look at our dividends. We have a debit balance here. It's in the debit column. Let's move this all the way up so we can see that. So it's in the debit balance column, and we are crediting it. So it ends up with a zero balance. Just make these all numbers so we can see the zeros show up. Okay. If we look at our professional service fees earned, it started out with a credit balance of $10,450. We debited it, $10,450.05, so it also has a zero balance. How about interest income? Same thing. It had a credit balance, and we debited it, so it is also zero. And all of our expenses, we had a debit balance, and we credited it for each one of these, so they are all also zeros. And our income summary had a zero balance. We debited and we credited for the same amount, so it also ends up with a zero balance. So let's take a look at our trial balance. This is our post-closing trial balance. This is our starting point for June. On June 1st, these are the balances of our accounts. As you notice, all of our permanent accounts have a balance in them because it carries forward. But when we come down here to our dividends, our revenue accounts, and all of our expense accounts are now at zero. So we can now start posting our activities for June and start accumulating our revenue and our expenses for June. And again, our permanent accounts, that's why we call them permanent accounts, because the balances continue forward for all of these. All of these accounts ended up being close to retained earnings. And that's how we end up with assets equals liabilities plus owner's equity. We close out the revenue, the expense, and the dividends all to retained earnings. And only retained earnings appears on our balance sheet. As you already know, because you did your income statement, retained earnings, and balance sheet, hopefully, already. And that concludes Part C with a lesson on closing. And so you should be able to do it in much less time than I did. Thanks for watching.